If what your bank taught you about money was true, then everyone would be rich. There are 9 specific myths that people hold about money, and it's time to break them. Myth number 2, put all your money in a 401k and wait 40 years for a big return, also known as the long haul mindset. Long haul, does that sound fun? It just sounds miserable. It sounds like the worst workout ever invented. When does the long haul end, by the way? Yeah, I guess when you die. That doesn't sound very good, right? But then maybe your heirs or your pets or whoever happens to be alive, they're going to be told they're in the long haul because it's the ideal excuse for people who want you to hand over your money, right? They say, oh, you're in it for the long haul, which means no accountability, not measuring what's happening today, and getting you to think so long term, it's to your detriment. See, part of the thought process here is that we're trained, taught, and educated that high risk equals high return. But risk defined as chance of loss. So how by increasing your chance of loss is that going to bring you a higher return? When people are telling you high risk equals high return, how much risk do they take? Well, if you're giving your money and they're getting a fee no matter what happens to that money, or even bailed out by the government, they didn't take any risk because the game was rigged for them and rigged against you. So what do you do instead? It's time to be a cash flow investor. It's time to have enough cash to cover your expenses. I call this economic independence. It is a game changer. Assets producing cash flow covering your basic expenses. So you don't have to actively work on a daily basis to cover your bills. When you have that freedom, work is a choice. When you have that freedom, you can swing for the fences in what you do. You can think more clearly about what you want your life to look like and what your vision is and what you want to be remembered for and what that purpose is on a daily basis without money coming in and crashing the conversation or keeping you up at night or being something that is a destroyer of dreams, which it is for far too many people that don't understand it. But I commend you because you're watching this and you're going to make a difference. When you got that cash flow that can cover your expenses, it is such a game changer because you've already won the game. Now you choose how you want to play. We've been really kind of bamboozled with this thought process I call accumulation. You hear it in the vernacular. People say this all the time. Accumulate wealth. Accumulation is slow, dogmatic, dangerous, and it's a concern because the U.S. Department of Labor says 95% of the time people are not economically independent in the United States at age 65, meaning they don't have enough cash to come in to cover their basic expenses. Accumulation theory is the enemy here. It's the villain. It's hard work with the wrong philosophy leading to bad results. And think about it. How much time do you spend worrying or working or doing all this to have a better life in the future and even neglecting a better life today because accumulation is a cousin to budgeting, which is all about scrimping, sacrificing, saving, and delaying and deferring and one day and someday, and that notion sickens me, and it's time to release you from that so you can actually utilize your cash along the way. You can keep your money in motion. You can focus more on cash flow because cash flow is king. Net worth is great if it boosts your cash flow. But if it doesn't, and we only think about building net worth, which is how much is our assets versus our liabilities. And the more net worth we have, yes, that's great on paper, but does that convert to dollars in your bank account? Is that coming in on a monthly basis, or do you have to liquidate it? And sometimes trying to liquidate net worth so you have enough cash to live is difficult during recessionary times, or maybe you own assets that aren't highly liquid. Maybe it's a certain type of real estate, or maybe it's a business, or maybe it's something that's a private investment and there's not a big market for it. One of the nice things about the stock market is it's really liquid, meaning I can cash that in pretty much at any time. Just depends on what other people feel it's worth, but it moves very quickly. So I don't want you to live like a pauper. I don't want you to have to scrimp and budget and save so that one day, someday, the long haul pays off and find out when you get there, it's not a retirement dream, it's a retirement nightmare. So long haul investing really takes away this responsibility and accountability for individuals. And unfortunately, people are funding these plans like retirement plans, 401ks, IRAs, RSPs in Canada, these types of plans. And at the same time, it's not performing as well as they expected. They might be borrowing on credit. And by borrowing on a credit card, you're paying a higher interest rate on your credit card just to fund a plan that you can't touch till at least 59.5. But even then, you have to pay tax. So most people never want to pay that tax, and they never get to access that money. And unfortunately, what if you're paying a higher interest rate than you're earning? That is a game that's never going to work out in your favor. Or what happens if all of a sudden you have a financial surprise? And we're all in store for financial surprises, but you have a financial surprise, a health issue, a family issue, you transition jobs, or your business doesn't do what you expected. I mean, I had business partners that died in 2006. That meant our processing accounts, our merchant accounts got shut down, and we couldn't process business for a while because we were all in the same accounts. And so that was a big hit. Not only did they die, I couldn't actually have money coming in. And all of a sudden, if I was all dependent upon net worth, I would have to liquidate more valuable assets quickly, therefore selling at a lower price. Now, here's the lesson there. If you've got cash, you can make money on the buy. So, in 2008, same thing happened. A lot of people, they had to borrow to survive. They had plenty of net worth, and they were rich that way, but they were cash flow poor, and that ended up destroying their net worth because they had to sell assets just to live. So let me break this down into 3 major flaws and problems with retirement plans, including the sacred cow of them all, the 401k. When I say sacred cow, it's like an unquestioned belief. The masses believe in it. See, a lot of times people are so caught up in the tax advantages, but it's actually tax deferral, not tax deductions. You put money into pre-tax into the retirement plan, and then you defer that into the future. Well, number one, what if taxes go up in the future? The government is $23 trillion in debt. Or hopefully you're making more money in the future, because if you don't make more money in the future, inflation makes it hard to buy the same amount of things today, 10, 20, and 30 years from now. So anyone that tells you you should be able to live off 70% of your income, either A, doesn't own Amazon Prime, because I bought a lot more since I've had that, or B, they're setting you up for failure. There's people in the 1980s that thought if they had $250,000 in a retirement plan, that would be suffice today. That's not even close. People aren't able to be economically independent off $250,000. Interest rates have been too low. Even if people have $1 million and they're so-called millionaires, if they're in retirement, how much interest are they getting from that? And by the time they pay taxes, they feel more like in poverty level, not wealth level, because a millionaire doesn't mean you get to spend $1 million. The second issue I have here is compound interest has a compound cost. So if you have money at $100,000 and you invest it for 30 years at 10%, grows to 1.74 million. Woohoo! Exciting. That's compound interest. 30 years, it looks really good. But what if there's some fees that come along with that retirement plan or with the mutual funds or whatever's funding it? So you only earn 9.2% instead of 10. Grows to 1.4 million. That's over a $300,000 cost to your bottom line. Compound interest also has compound cost. So we've got to be really calculated about taxes and costs and fees. Look up and learn what a 12B1 fee is, or an expense ratio, or legal fees, or admin fees, or a myriad of fees that could confiscate your wealth. The third part is a lot of these are hidden fees, right? They're not things that we think about every single day. We just look at what did the average rate of return in the stock market come out to be. But averages and actual returns are two separate things. Averages don't account for fees. So in business, we call that revenue. You could have a great revenue and be like, oh, I make $100 million in revenue, and that sounds great. But if it costs you $101 million of revenue to get to the 100 million, not so great anymore, you're losing money. So we've really got to detect and understand, almost like a financial detective. What are the fees? What are they costing you? Because this really starts to add up. So what can you do instead of long haul investing? Well, first and foremost is to invest in yourself. Figure out your skill sets, your talents, your abilities, whatever you might call it, and invest in that so that you can add more value out into the world. The more value you can add to the more people, the more money you can actually make. And if you own a business, you can invest back into that business, whether it's into people, so you have very best people around you that free you up to do what you do best, the right processes that support those people to become more efficient, or the right technology and procedures that allow you to have automation so you have even more reach and you can make more money through scale and leverage. Another thing that you can do other than just subject yourself to long haul investing, the buy, hold, and pray, hope it works out, you can get crystal clear on your purpose in life. What is it that you really are up to and want to do? And what if you funded your dream instead of everyone else's? Rather than thinking about investing early, often, and always, rather than thinking that the earlier you start, the more you'll have in the future, and you rob that money from your own purpose and your own abilities. See, I want you to think about investing first and foremost in yourself, and then secondarily, let's get really efficient with your money. Let's pay off high interest rate loans. Let's get better interest rates with your loans. Let's build up some savings accounts so you have staying power, and if there's any financial surprise, you don't have to go into debt or go borrow to handle that situation. So you've invested in yourself, you've invested in your basic infrastructure, and then you're going to have more abundance because you've got to take care of yourself, your family, and have a high quality of life because you're your greatest asset, not a stock, bond, or piece of real estate. Don't neglect yourself. If you sacrifice your whole life to get the reward at the end, you're taking a serious risk that when you get there, it won't be what you expected it to be. Make your money work for you right now. Instead of putting it off until one day, or even someday way in the distant future, now you can actually invest in yourself because you have the knowledge to transform your thoughts into profits and build the life that you love. If you want to learn more on this topic, check out my video on financial planning.